Welcome. We're your shortcut to getting smart on the Canadian housing market.
That's right.
We'll cut through the noise, give you a full picture of the mortgage and housing trends.
Yeah.
And this deep dive, it's specifically for you, our mortgage broker listeners. We want to arm you with the latest insights so you can guide your clients with confidence.
And well, it was definitely a month of interesting signals, maybe even contradictions, in Canadian real estate.
Oh, yeah?
Yeah, you had some areas where affordability got worse, but then surprisingly, others actually saw some improvement. And what's really fascinating, I think, are these new reports that are kind of challenging our usual thinking about supply and demand. Makes you rethink the whole picture.
Okay, challenging assumptions. I like that. And you mentioned creative ownership models, too.
Exactly. I've seen some really innovative stuff starting to gain some real traction.
So quite a bit on the table then. What does it all mean for you, the listener?
Well, we're going to unpack those latest affordability numbers first.
Right.
Then look at the regional shifts, dive into that big national housing supply challenge, find out what renters are thinking, and wrap it up with a look at a pretty cool alternative for buying recreational properties.
Sounds good. A lot to cover, but definitely essential for getting the nuances right now.
Absolutely.
Okay, so if May gave us this mixed bag of signals, where do you start unpacking? I guess the first question for most people is always the bottom line, right? Affordability. How affordable is a home now? How'd that change in May?
Let's jump right into that May mortgage affordability report. Nationally, the average Canadian home price, it nudged up slightly in May 2025, hit 691,299 people.
Okay, so up 1.9% from April.
Right, but still down year over year, about 1.8%.
Gotcha.
But here's what's critical for you to grasp. Even though mortgage rates were, largely unchanged, RateHub.ca's report, it showed affordability actually worsened in 8 out of the 13 cities they surveyed.
8 out of 13. Wow. So the buyer-friendly vibe we saw in spring.
Yeah.
Maybe that's fading.
Yeah. It suggests that, as sales firm up, those conditions might be ending. RBC even thinks market confidence will sort of gradually rebuild now that some uncertainty around U.S. tariffs is clearing up.
That's really counterintuitive, though, isn't it? If rates are flat, what's pushing affordability down in so many places?
Yeah.
Can you walk us through some of those cities where buyers needed more income?
Absolutely. It wasn't everywhere, but some jumps were pretty significant. St. John's, Newfoundland, they saw the biggest hit. Needed an extra $690 in annual income.
Okay.
Brings the total needed to $86,450. That's about $45 more a month on the mortgage payment, mostly because home prices there jumped almost $9,000.
Right, so price is the driver there.
Exactly. Halifax was next, needed an extra $4,430 a year. Montreal, an extra $980. These aren't like tiny adjustments. They show real price pressure in those markets.
And what about the big ones like Toronto?
Yeah, Toronto too. Average price climbed over $1 million again, $1,012,800. So now you need $206,500 in annual income. That's up $660 from the previous month. Monthly payment up $17.
Okay, so clear price momentum in many spots, even without rate hikes. But you said it was a mixed bag. Amidst all this, there were some bright spots, right?
Yeah.
Where did things actually get better? What's the story there?
Indeed. And this is where you really see the local market differences shine. Calgary, for example, was remarkably stable, no change. Average price held at $583,000.
Okay, steady Eddie.
But Hamilton, that was the real standout. It saw what RateHub called a massive improvement. You needed $3,480 less income annually.
Wow, less. That's significant.
Yeah, saves about $93 a month on the mortgage. And this drop, it seems directly linked to worries about those U.S. tariffs on steel and aluminum hitting the local industry there.
Okay, so external economic forces really hitting home there. Shows it's not just about interest rates, is it?
Not at all. It's a powerful example, and other big cities saw some relief too.
Like Vancouver. Still the most expensive, I assume.
Oh, absolutely. Still number one at $1,177,100. But get this, average prices there actually declined by $7,500 in May.
Really? So slightly cheaper.
Slightly. Monthly mortgage dropped $38. Still need the highest income in Canada, $237,550, mind you.
Of course.
Victoria and Ottawa also saw prices drop a bit. Mortgage costs eased slightly. The key takeaway for you, the broker, isn't just that affordability is shifting, but why. These shifts are super localized, often driven by unique regional economies.
So national headlines only tell part of the story. Your local knowledge is key.
It's your most powerful tool right now. Absolutely.
Speaking of local, to really get the market's complexity, we can't just look at the big cities. Let's zoom into, say, Barrie, Ontario. The condo market there tells a really different Very specific story.
Yeah, Barrie's interesting. Condo sales, still really low, only 33 sold in May. That's down a huge 34% from last year.
34% drop. And what about inventory?
Here's a clincher for Barrie. Condo inventory, record high. 293 units for sale. Compare that to just 195 back in June 2024.
Whoa, that's a lot of condos sitting there. Apartments, townhouses.
Yep, a mix. 209 apartments, 75 townhouses, even 9 life lease units. So the big question in a market like that is, what does this glut mean for buyers and sellers?
Well, it definitely means even though the Bank of Canada held its rate, which you'd think might boost confidence, prices aren't automatically going up in Barrie, not by a long shot.
Exactly. You'd need to see fewer price drops, quicker sales, basically shorter days on market before prices firm up.
And what's also interesting there is that freehold houses, the regular detached ones, have apparently become more affordable. So they're drawing buyers away from condo townhouses.
Right, partly because you don't have those monthly condo fees with a freehold. Makes a difference.
So for your clients looking in Barrie, if they're buyers, sounds like they have some leverage.
Definitely. Advice is look at lots of properties, put protective conditions in your offer, and crucially, work with a realtor who really knows the specific condo buildings.
And for sellers in Barrie,
Price it right, make it shine staging, decluttering, and again, find a realtor who specializes in condos there. It's a buyer's market you need to stand out. Strategic positioning is absolutely key.
okay, this deep dive into affordability really shows a complex city-by-city picture. But none of this happens in isolation, right? It's all shaped by the elephant in the room, Canada's housing supply challenge.
Yeah, let's tackle that. The CMHC, Canada Mortgage and Housing Corporation, they've put out some incredibly ambitious targets.
Ambitious is one word for it.
They're saying Canada needs to basically double home construction over the next 10 years, just to get back to the affordability levels we saw in, 2019.
Double. What does that mean in actual numbers?
It means building somewhere between 430,000 and 480,000 new units every single year until 2035.
And what are we building now?
Projections are only around 245,000 starts a year. So, yeah, a huge gap. CMHC even said trying to get back to 2004 affordability levels. That's just no longer realistic after the post-COVID price surge.
Doubling construction. I mean, given labor shortages, regulations, delays, how realistic is that really? Are we just setting ourselves up for failure here?
That's the critical question, isn't it? CMHC is very clear. Achieving this, it needs a significantly larger and modernized workforce, more private investment, fewer delays, less red tape.
And the stick. If we don't increase supply.
Prices and rents just keep climbing. That's the warning.
But there's a carrot, right? If we can meet those 2019 affordability goals.
The potential payoff is big. CMHC estimates house prices could be roughly 25% lower and average rents may be 5% lower by 2035 compared to just letting current trends continue.
Okay, 25% lower prices. That's a big incentive. But you mentioned the challenge isn't the same everywhere. Regional differences.
Stark differences. Take Calgary. They've been breaking housing start records 3 years running. Hit over 24,000 starts in 2024.
Sounds great.
But the city still needs about 9,000 more starts than that every year for the next decade, just to get back to 2019 affordability, where housing costs aren't more than 30% of income.
9,000 more on top of record highs. Wow. That really underscores the scale. How do they propose doing that?
CMHC says it requires fundamental changes, using AI, robotics, automation in building, plus a much bigger, better-trained workforce.
Okay, so major transformation needed there. What about Edmonton? They also had record starts, right?
They did. Over 18,000 starts in 2024, and the CMHC report is actually more optimistic for Edmonton.
Oh.
It suggests Edmonton is building enough right now to maintain its current affordability over the next decade.
Okay, that's a very different outlook than Calgary needing a huge boost.
Very different, though. Even Edmonton still needs over 16,000 new units each year just to stay level. So it's no surprise it's becoming a magnet for young families looking for that affordability edge, which, of course, adds to demand, too.
Right. So across the board, the big challenges are still those labor shortages, skills gaps.
Absolutely. Persistent labor issues, unemployment in some areas, skills mismatches. Industry folks keep saying they need government land approvals, infrastructure, but also a societal shift. We need to value careers in the trades more.
But here's where it gets really interesting, maybe confusing. While CMHC is yelling double the building, other reports are pointing out something else. Didn't one suggest Canada started construction on Like more than 2 homes per person added to the population in Q1 this year?
Yes, that's the conflicting data point that's emerged. Housing starts did drop recently, but population growth slowed down even more dramatically. Only about 20,000 people added nationally in Q1 2025. Ontario and BC actually saw population shrink slightly quarter over quarter, which is rare.
Okay, hang on. If the main story is build more because population is booming, but then population growth tanks, does that change the whole supply narrative, or at least the urgency? What's the aha moment here for our listeners?
It's a critical aha moment, I think. It suggests it might not be as simple as more people equals need X more houses, full stop. The relationship seems more dynamic.
So maybe the type of housing or where it's needed becomes even more important than just the raw number.
Could be. And BMO Capital Markets, they're leaning into this complexity. They put out a warning saying the real estate correction is far from over, even with prices already down 17.5% from the peak.
Far from over. How long are they talking?
They say corrections like this are measured in years, usually 2 to 15 years, not months. And looking at current sales to new listings ratios, basically more homes coming on than selling, they think further price drops are likely. Canadian prices actually hit a 4-year low in May.
A 4-year low.
Right.
Okay, so a very complex supply and demand picture. Let's shift gears slightly for segment 3. Let's talk about renters, market stability, and these new ownership models you mentioned. What are renters thinking right now? Are they still hoping to buy?
Oh yeah, the dream is definitely alive. New data shows 54% of Canadian renters plan to buy a home within 5 years.
Over half. That's huge.
And a third of those want to buy within the next 2 years. So a massive pool of potential buyers. But a lot of them are playing the waiting game.
Waiting for what? Prices to drop? Rates to fall?
Both. About 40% are waiting for prices to come down more, and 29% are holding out for more interest rate cuts. Remember, the Bank of Canada's rate has been sitting at 2.75% since March.
Right. But timing the market, that's risky, isn't it?
Royal LePage's CEO, Phil Soper, basically advises against it. He says home prices, like the cost of living generally, rarely go down over the long term. So for your clients, it's about managing those expectations, maybe exploring other paths if waiting feels endless.
And it's not just about waiting, is it? There are real barriers.
Huge barriers. For over a quarter of renters, the big problem is simply not qualifying for a mortgage. Not enough down payment or household income is too low.
That's tough. And it points to some serious financial strain.
Absolutely. Get this. 30% of renters said they've had to cut back on saving for retirement or other goals just to make rent.
Oof, that's a hard trade-off. Really makes you worry about long-term financial health for a lot of people. Walking a tightrope.
It really is. Stark reminder. Now, on the broader market stability front, there was some positive news in May. CREA, the Canadian Real Estate Association, their data showed national home sales actually rose 3.6% from April to May.
Okay, first monthly increase since last November?
That's right. And importantly, national prices stopped falling in May. They kind of stabilized.
And CRE's economists linked this to the easing of those U.S. tariff threats, right? Less chaos and uncertainty.
Exactly. But it's still fragile. While retail sales bounced back a bit in April, the early look at May suggests a pretty sharp drop, maybe 1.1%.
So consumer spending might be weakening again? Trade tensions still biting?
Seems like it. Weaker demand, ongoing trade worries. The economy's navigating a really delicate path right now.
Okay, so amidst all this uncertainty and affordability pressure, the market is innovating. Let's talk about those new ownership models. You mentioned fractional co-ownership for cottages. Tell me more.
Yeah, this is really gaining traction. It's basically a way to make that cottage dream affordable. You buy a share of a property, it could be with family, friends, even strangers you're matched with.
Okay, so how's that different from a timeshare? Because timeshares sometimes get a bad rap.
Good question. It's fundamentally different. With fractional, you own a deeded share of the actual real estate. You're on the title. A timeshare is often just buying the right to use a property for a certain time, often owned by a corporation.
Ah, okay. So real ownership, more autonomy.
Generally, yes. More control, guaranteed weeks. Like you might buy a 110th share for under $100,000, and that gets you 5 weeks a year. It's like a modern co-op for your vacation spot.
Interesting. And you said cottage prices are still expected to rise?
Yep, projected average increase of 1.8% across the recreational market in 2025. So this model offers a way in. One thing to note, these properties are usually set up to be 100% debt-free.
Meaning no traditional mortgage on your share?
Typically not. Buyers usually use personal loans, lines of credit, that kind of thing.
Okay. And the downsides? Less flexibility, maybe? Can't just show up whenever?
Exactly. Less personal customization of the place,
Yeah.
and your usage times are usually fixed in advance. But what's surprising is who's buying.
Not just young families priced out.
Initially, that was the thought, but they're seeing a lot of buyers in their 50s and 60s. Some are buying shares for their adult kids or grandkids. Others just like the idea of enjoying a cottage without all the maintenance headaches of full ownership.
That makes sense. So if a client is considering this, what's the key advice?
Treat the co-ownership agreement like a prenuptial agreement. Seriously, ask all the questions. Who are the other owners? How do votes work? How do you sell your share if you need to? Who manages the property? What are the financials? How is usage time allocated and managed?
Lots to dig into. It's a complex legal setup.
Definitely needs thorough review. But it
Yeah.
really does open up possibilities for people dreaming of that recreational property lifestyle.
Wow, what a deep dive indeed. We've covered a lot. A really complex picture for May. Affordability shifting differently everywhere. That massive national supply challenge that's not as simple as it looks.
Right, especially with those conflicting population growth numbers.
Exactly. Plus, we looked at what renters are up against, their aspirations, the barriers.
And these innovative models like fractional ownership starting to carve out a niche.
So, wrapping this up, the final thought for you, our listener. In a market with so many moving parts, national targets, local price swings, changing buyer preferences, new ways to own truth, how does this deeper understanding shift things for you? What new opportunities or maybe challenges does this prevent in how you guide your clients on their unique homeownership journeys?
Yeah, where might that next wave of opportunity lie for you? Or how might you need to pivot your advice in this constantly shifting landscape? Something to really think about.